Does monetary inflation reduce debt but raise borrowing costs? Imagine a world where the money in your pocket is worth less every year. That's what happens when there is monetary inflation, which is an increase in the total money supply caused by central bank policies. This kind of inflation can make existing debts easier to pay off because the money used to settle those debts is worth less in real terms. If you owe $1,000 today and inflation rises, that same $1,000 will buy fewer goods and services in the future. So, in effect, your debt becomes less burdensome because you are paying back with money that has less value. This can help governments and individuals manage their debt better, especially if their debts are in the local currency. But here's the catch. While inflation can make existing debts easier to pay, it also pushes up the cost of borrowing new money. Why? Because lenders want to protect themselves from losing money due to inflation. They demand higher interest rates to make up for the decrease in purchasing power. When inflation expectations go up, lenders will charge more for loans, especially for long-term borrowing. This means that even if short-term interest rates stay low, long-term rates tend to rise when inflation is expected to increase. The reason for this is that inflation affects the confidence in the economy and the central bank's ability to control prices. If people think inflation will keep rising, lenders will want higher interest rates to compensate for the risk. This can make borrowing more expensive for everyone, including governments, businesses, and consumers. The type of inflation also matters. If inflation is driven by strong economic growth and increased spending, it might temporarily lower borrowing costs because it signals a healthy economy. On the other hand, if inflation is caused by rising costs of production or supply shocks, it can make borrowing more costly because it adds economic uncertainty. In addition, if lenders doubt that the central bank can control inflation, they may demand even higher interest rates or refuse to lend. This can lead governments to borrow in foreign currencies to avoid high local rates, but that introduces currency risk. So, while monetary inflation can reduce the real value of existing debt, it often leads to higher borrowing costs in nominal terms. This means that the cost of new loans and refinancing can go up, increasing the overall interest payments for governments and businesses. The balance between these effects depends on how much inflation occurs and what causes it. If inflation is well managed, the benefits of reduced debt burdens might outweigh the higher costs of borrowing. But if inflation spirals out of control, it can make borrowing more expensive and threaten economic stability.